OG John AG here, and what I'm about to show you will blow your mind. Silver just had its worst day in history, down 31% to close below $80. Not the worst in decades, not the worst in 50 years, the absolute worst on record, ever. $7 trillion vanished from precious metals in one trading session. Silver alone wiped out roughly $2 trillion. Gold dropped 11%, erasing about $5 trillion. Platinum crashed 20%. Palladium plummeted 16%. And here's what's going to shock you. This wasn't random. This wasn't panic selling. This was orchestrated. And I've got the evidence. When you dig into the latest COMEX report, JPMorgan closed their silver shorts at the exact bottom of the crash, right at the lowest point. And from there, everything started bouncing back. This isn't luck. This isn't coincidence. This is documented proof that Friday's massacre was planned. Looking at the subscriber numbers, about 3 out of 4 of you are watching but haven't hit subscribe yet. If this content is cutting through the noise and showing you what's really happening, please subscribe. That's how I track the real community growth. If you're getting value here, drop OG John AG in the comments. It helps me and my team understand what's working and serve you better. If this isn't your style, no worries. I'm not chasing empty numbers. I want people who demand honest analysis, not the polished, misleading content you get from mainstream sources. Now let me break down exactly what happened. The COMEX report dated January 30th shows JPMorgan Securities stopped 633 silver contracts. The timing? Perfectly at the bottom. Price crashed from over $100 down to the low 70s, and right at the exact bottom, JPMorgan closed 633 short positions. Then what happened? Recovery began immediately. This isn't speculation. This is documented COMEX data. And here's another smoking gun. 2,514 silver February contracts have delivery notices. Physical demand is still roaring. But on January 30th, COMEX Silver traded roughly 368,561 futures contracts and 28,152 options contracts. Each COMEX Silver contract equals 5,000 ounces. That's about 396,700 contracts total, translating to roughly 1.98 billion ounces of silver traded in one day. Let me repeat that. 1.98 billion ounces. Almost 2 billion ounces. In a world where annual mine supply is 800 to 850 million ounces, they traded more than twice the entire global production in one session. This wasn't price discovery. This was liquidity manipulation using fictional ounces. And the timing. Let's connect the pieces. U.S. government preparing for shutdown, then Senate passes bill to avoid it. First U.S. bank failure of 2026. Chicago's Metropolitan Capital Bank collapses, closed by Illinois regulators due to unsafe conditions. Assets $261 million, deposits $212 million, $19.7 million hit to FDIC. Polymarket odds of bank failure on January 31st hit 99%. Something major is brewing. Liquidity tightening across the system, and right on cue. Paper silver gets demolished. Perfect timing. Totally organic. Just coincidence, right? Wrong. While dealers suspend trading, delivery times jump to 8-16 weeks. Inventories disappear. Physical premiums disconnect. The paper market dumps multiple years of global production in hours. Paper markets clear fear. Physical markets clear reality. And when governments stumble, banks fail, and trust fractures, real metal doesn't return to market. It vanishes from it. Here's what you need to grasp. Shanghai spot silver is currently at $120. COMEX closed at $84. That's a $37 premium. After a 31% crash, the biggest daily loss ever, and the premium is still $37. Physical silver in China trades 44% above COMEX. The premium didn't shrink, didn't vanish, it expanded. Before we continue, let me address the two types of people watching this. First, the long-term stackers, that's most of you, around 70% of this channel. Many have been accumulating for decades. You have a strategy and you stick to it. You understand fundamentals. Your time frame isn't daily or hourly. It's monthly, yearly. You let time work for you. You see a 31% crash and you're not rattled. Actually, you see opportunity. Whether jumping in now or hoping it drops further so you can stack more, for you, nothing fundamental has changed. With Shanghai premium still elevated, you see the growing split between paper and physical markets. You're calm, seeing the bigger picture. Even with this drop, you're probably more interested that we're still up 19% on monthly close. This volatility doesn't shake you. But then there are short-term traders, especially those without plans who think markets move in straight lines. For you, this has been devastating. A 31% daily crash with high leverage is a liquidation nightmare. Some may have profited, but if you were overlevered, on the wrong side, or trading without discipline, this move wiped you out. Forced liquidations don't care about your analysis. I've been warning about this for quite some time. Overleveraging, risks of short-term trading without strategy. Go back and watch previous videos. If you're new here, watch them. If you've been with me from the beginning, you knew this was possible. We had a plan. For newcomers, let me be clear. I don't sell signals at mentorship or courses. Real OGs here know this. My handle is OG John AG on both YouTube and Twitter. If you're not following there, you're missing real-time updates. We discussed that a move to $86 and below was possible after Fed chair pick, and it happened. The veterans already knew. Be aware of fake accounts manipulating content, repackaging my analysis, giving false numbers and stories. I'm not responsible for that. Verify the handle. Follow the real account. I don't give you one picture here. No fear, no greed. I've never given signals or taken sides. I give unbiased truth, and I've always told you to use your own judgment. Know which camp you're in, long-term stacker or short-term trader, and act accordingly. So let's break down what this COMEX report actually reveals. JPMorgan closed 633 silver short contracts at the exact bottom, not near the bottom, at the bottom. Then price recovered. This proves the crash was timed, controlled, executed with precision. They know exactly where the bottom is because they're creating it. They dump massive paper supply, trigger cascading liquidations, hit all stops, flush weak hands, then close shorts at the low. It's a perfect trade, visible in COMEX data. Here's the mid-video revelation that changes everything. This wasn't a correction. It was deliberate paper slaughter. The sharp drop, gold down 10%, silver plunging 31%, wasn't normal market movement. It was triggered by massive sales on paper futures markets by major banks. No new physical ounces were created by this move. Fundamentals haven't changed. Investment buying remains strong, especially in physical bars and coins. Central banks continue buying gold. Silver supply stays tight. Mine output grows slowly while above-ground stocks get drained. Industrial demand for silver stays red hot. Solar, electronics, EVs, all pulling metal off market. This creates solid support quickly, especially for silver. Miners now have stable base to rebuild from. Mining stocks expected to double over next 6 to 12 months as dust settles and bull market resumes. 1.98 billion ounces of paper silver traded in one day. Annual global mine supply is 850 million. They traded more than twice annual production in hours. While physical buyers wait 8 to 16 weeks for delivery, while Shanghai premiums sit at $37, while COMEX delivery notices total 2,514 contracts, paper and physical markets are completely disconnected, and proof this was planned is right there in COMEX report. JPMorgan closed 633 shorts at exact bottom. Here's another catalyst. First U.S. bank failure of 2026. Metropolitan Capital closed by Illinois regulators. Polymarket had 99% odds of bank failure January 31st, and it happened. Assets $261 million, not systemically important, but it's the first. When the first bank fails, liquidity concerns spread. Counterparty risk increases. Trust erodes. What happens? Flight to safety. Except this time, safe haven assets got crushed first. Why? Because initial move is always liquidation. Margin calls force, selling everything, including gold and silver. But then comes phase 2, realization that system is fragile. Banks are failing. Trust is breaking. That's when safe haven bid returns, when physical premiums explode, when delivery demand surges. We're in transition between phase 1 and phase 2 right now. Let's address the bearish case, because a 31% crash, biggest daily loss on record, is catastrophic if you were wrong-sided. This isn't something to dismiss. If you were trading leveraged, you got liquidated. If you had tight stops, you got stopped at worse prices. If you were overpositioned, you're massively underwater. Technical damage is severe. And here's another risk. CME is raising margins on COMEX gold and silver futures after prices suffered biggest slides in decades. Margin hikes after crash, adding insult to injury. If you held futures positions and survived crash, now you need more capital or get forced out. That creates follow-on selling pressure. First bank failure just happened. If more banks fail, if liquidity continues tightening, if credit conditions worsen, we could see more forced selling across all assets. Initial reaction to financial stress is always risk-off. Sell everything. Raise cash. Doesn't matter that gold and silver are supposed safe havens. In first stage of crisis, margin calls and liquidity needs forced selling liquid assets first. Paper market can stay irrational longer than most traders stay solvent. We just saw $7 trillion erased in one day. No guarantee it stops here. Could see more selling, liquidations, panic. If you're trading this leveraged, this environment is a meat grinder. Even if long-term thesis is correct, short-term volatility can wipe you out before turn comes. But here's why bearish case for paper doesn't change bullish case for physical. JPMorgan closed 633 short contracts at exact bottom, not speculation. COMEX data. They timed perfectly. How? Because they orchestrated it. 2,514 delivery notices for February. Physical demand still there. 1.98 billion ounces paper traded versus 850 million annual mine supply. Paper fiction now over twice annual production traded in day. Shanghai premium $37 after biggest daily crash on record, 44% premium. In normal markets, premiums compress or disappear during crashes. Physical sellers panic, flood market, premiums go negative, but not this time. Shanghai holding at 44% over COMEX. Physical buyers in China paying nearly 50% more than paper traders in New York after worst crash ever. That's not broken bull market. That's rigged paper market losing all credibility. Dealers suspending trading. Delivery times 8 to 16 weeks. Inventories vanishing. Physical premiums detaching. Paper market dumps equivalent of over 2 years global production in hours. This is endgame. What happens when paper system on edge of breaking? They need one final massive flush to reset positioning before reality overwhelms them. Where does this leave us? 3 key takeaways. Number 1, JPMorgan closed 633 silver short contracts at exact bottom of crash. Documented in COMEX report dated January 30th. Not near bottom. AT bottom. Then price recovered. This isn't coincidence. Isn't conspiracy theory. This is proof Friday crash was planned. Timed, executed with precision. They create bottom, close shorts, profit both ways. Number 2, 1.98 billion ounces paper silver traded January 30th. Annual global mine supply, 850 million ounces. They traded more than twice annual production in one day, while physical buyers wait 8 to 16 weeks. While Shanghai premiums sit at 37s, 44% over COMEX, while delivery notices total 2,514 contracts, paper market is pure fiction, physical market screaming deficit. Number 3, first U.S. bank failure of 2026. Metropolitan Capital closed by Illinois regulators. Polymarket had 99% odds. It happened. Banks failing, liquidity tightening, trust cracking. Initial reaction is risk-off liquidation, but phase 2 is flight to safety. We're in transition. CME hiking margins after crash adds more pressure short-term, but also confirms system stressed and fragile. Unresolved tension. We just saw biggest daily silver loss on record, but JPMorgan's COMEX positioning proves it was planned. Does second wave of selling come? Or does physical reality reassert now that shorts closed and weak hands flushed? With first bank failure confirmed, how many more coming? When does flight to safety phase begin? $7 trillion erased, biggest daily loss ever. First bank failure of year, 1.98 billion ounces paper dumped in one day, and JPMorgan closed 633 shorts at exact bottom. This is the proof. This is smoking gun. Friday crash was planned. They timed it perfectly. Physical market telling you paper system on borrowed time. Do your own research. Understand risks. If trading leveraged, this volatility is liquidation machine. 31% crashes wipe over leveraged positions instantly. But if you understand what's actually happening, JPMorgan timing bottom perfectly, paper trading twice annual production in day, physical premiums holding at 44%, then you know this crash isn't about fundamentals, it's about desperation. One final flush before paper system breaks. Invest with logic, not hype. OG out.